Hello class and welcome. And in this video, we will be going over some concepts that are going to be very helpful for you for chapter 2 in Accounting 250. This is only part of the PowerPoint slides that are provided, but I want to go over the things that are most important and allow you to kind of read through the other things as you see fit. So first of all, we need to understand the accounting equation. What is the accounting equation? Well, it is assets equals liabilities plus owner's equity. But what are these things, right? Assets are the things that the business owns, like cash, inventory, rights to accounts receivable, right? Customers who need to pay us for goods or services that we've provided who have not yet paid us yet. Fixed assets like property, plant, and equipment. These are assets, the things that we own. Liabilities are the things that we owe, right? Accounts payable, maybe wages payable that have been earned but not yet paid. Credit cards, things like that. These are our liabilities, things that we owe. And then we have owner's equity. These owner's equity is the rights of the owners. And it is essentially made up of kind of the activity of the business, the revenue less expenses, and also includes owners' deposits of their own funds into the business. Those are the owner's equity. So the accounting equation is assets equals liabilities plus owner's equity. And this is how we keep all of our accounting entries in balance. But what does that look like? Well, first of all, here's kind of what owner's equity is made up of. Owner's investments minus owner's withdrawals plus revenues minus expenses. That is all of owner's equity here. And then when we think about the accounting equation, it actually gives us some insight to how we treat these accounts when we're making accounting entries. So for example, assets, if we go back up to assets, look, it's on the left side of the equal sign. And when we think about debits and credits, especially when we get into like T accounts and things like that, debits go on the left and credits go on the right. So we can think of debit as left and credit as right. So we increase an asset, let's go to increase first. We increase an asset with a debit. We also increase expenses with a debit because they reduce owner's equity, which is on the right side of the accounting equation. We increase liabilities and revenue with a credit, right? And equity, right? With a credit. We decrease these with the opposite, right? So we decrease assets with a credit, we decrease expenses with a credit, and we decrease liabilities, equity, and revenue with a debit. Now, the natural balances of these accounts are basically what we would expect the resting balance of the account to be. For example, we don't expect our bank account to be negative, so the balance in the bank account should be a debit balance or a positive balance normally, right? And conversely, a liability like accounts payable, we expect that that natural balance to be a credit. So let's look at this example really quick. If we had a transaction on November 1st where Chris Clark deposited $25,000 into a bank account in the name of Net Solutions, we would have an asset increase, right, the cash of $25,000, and we would have an owner's equity increase, the equity, or Chris Clark capital, we might call it, of $25,000. So we would have a debit to cash, notice it's on the left of the equal sign, a debit to cash for $25,000, and a credit to Chris Clark's capital account for $25,000. Now we're going to assume that Net Solutions paid $20,000 for the purchase of land as a future building site. So the cash is going to have to decrease $20,000, and the land will increase $20,000. So the left side of the equal sign, right, the assets will still equal $25,000, $5,000 in cash, $20,000 in land, and Chris Clark's capital account did not change. Now let's assume that Net Solutions purchased supplies for $1,350 and agreed to pay the supplier in the future. So basically what they're doing is they're creating a liability account called accounts payable. And items such as supplies that will be used in the business in the future are called prepaid expenses, essentially, which are assets, right? The supplies are an asset. So if we look back at our accounting equation, now we have $5,000 of cash, $1,350 in supplies. We didn't spend cash on it because we got the accounts payable for $1,350 and the $20,000 in land. So we have a total of $26,350 in assets, $1,350 in liabilities, and $25,000 in owner's equity equals $26,350. Now, if Net Solutions receives cash for $7,500 for providing services to customers, what would that look like? Well, we have fees earned. We got an extra $7,500 in cash, so that brings our cash balance up to $12,500. We have fees earned of $7,500. That's part of the owner's equity side of the accounting equation. So still assets are $33,850. The liabilities plus owner's equity are also $33,850. Now we have a summary of all the transactions for Net Solutions, which are also available in your textbook. But if we look at this next transaction, it doesn't tell us, like, we don't have a text telling us what happened, but we can decipher what happened. We know for sure we spent $3,650 in cash. And what did we spend it on? Well, $2,125 was on wages. $800 was on rent, $450 was on utilities, and $275 was miscellaneous expenses. What about this next transaction? $950 of cash we spent. Oh, what did we do? Well, we paid part of our accounts payable. $950 in accounts payable, bringing that balance down to $400. Now, here, we've used up some of our supplies. In G, we've used $800 worth of our supplies, which means we have supplies expense of $800. Now, the next transaction, we've taken out $2,000 in cash as a draw, Chris Clark drawing. So basically, we're reducing his equity account or his capital account. This is a contra account to his capital account, meaning it serves to reduce his capital account. So we took $2,000 in cash and he drew it out as an owner's draw, essentially. So even though we don't have the text that describes each of these transactions, we can still decipher what has happened. And now anytime over here we have a positive amount, that's a debit to one of these asset accounts. We have a negative, that's a credit to the asset account. So if we were going to look at, let's say, this transaction here, E, these wages, even though they show negative, they're negative because they serve to reduce owner's equity, right? So we would have a debit to wages expense, rent expense, a utilities expense, and miscellaneous expense, and a credit to cash for $36.50, and then these amounts respectively for each of those accounts debits. If we looked at this D, right, we have a debit to cash for $7,500 and a credit to fees earned for $7,500. So that's how those would look. Or if we had T accounts, right, if we had a big T on the fees earned side, on the right side of fees earned, we would have $7,500, and on the left side of cash of that T account, we'd have $7,500. So that's essentially the essential to what that would look like. So let's pull up Cengage right here and look at a couple of these transactions for problem 5 on your homework. Now your numbers might be different, but the concept will be the same, right? So on January 1st, we paid rent for the month for $4,900. So we have a debit, it's on the left-hand side to rent expense for $4,900, and we have a credit to cash for $4,900. If we had paid advertising expense of $3,130, we'd have a debit to advertising expense, $3,130, and a credit to cash for $3,130. If we paid cash for supplies, $1,340, we'd have a debit to supplies and a credit to cash for that amount. Now, if we receive cash from a customer, let's look at the 12th here. We have a debit to cash and we have a credit to accounts receivable. Why? Because we received cash from customers on account. We weren't performing the service now. We had already performed it. So we're debiting cash and we're reducing that accounts receivable balance that we had previously booked, even though that's not part of that original entry is not part of this example. We're reducing accounts receivable by crediting it for 6710. Now, if we looked at fees earned, right? Fees earned and billed to customers for the month, $44,700. This is what an accounts receivable transaction would look like when we're not receiving the cash yet. So accounts receivable, we debited for $44,700 and we credited fees earned for $44,700. So that's essentially what that would look like. And you'll have problems like this throughout your homework. And Tell Me More will also help you get through them. But that is the essential of what you're going to need to know for Chapter 2 here. I hope that you have a great week. If you do have any questions, please reach out and let me know. And again, I pray that you have a blessed week. Thank you.